Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing metamaterial stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Metamaterials is an advanced materials and nanotechnology company. The technology it uses is holography, lithography, and medical wireless sensing. It creates solutions with functional materials that can enhance, block, or absorb energy for a wide range of applications including medical, automotive, electronics, and aerospace. It is pioneering a new class of materials called metamaterials. It develops its products using computer algorithms using the desired material. The company uses artificial intelligence software to design a library of patterns for different applications. It typically develops new custom solutions within hours versus most companies that take months. Since 2019, it has been working on creating glasses for Airbus to help pilots avoid glare while in the cockpit, because glare can really compromise their vision when flying. Meta was funded by a SPAC. A special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. In June 2021, the merger was completed and Meta received $160 million in cash proceeds. The SPAC that acquired Meta was Torchlight. The company is headquartered in Nova Scotia, Canada, and was founded in 2011. The ticker trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a small cap company, 450 million market cap. They're trading at $158 a share, and they have 285 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They're not bringing in much revenue at this point, so they have negative free cash flow each year. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's also negative each year. Revenue is a sales for the company, and that's pretty low. It was highest in 2021 at $4 million. This is the company's income statement. The top line is the revenue, the sales. That was the highest in 2021 at $4 million. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that is positive each year, $3.4 million in 2021. Below that is operating expenses. They spend a lot on research and development. That was $56 million. Gross profit minus operating expenses gives you your operating income, which is negative every year. They spent $1.1 million of interest on their debt, which was lower than 2020 of $1.4 million. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. When we look at the company's income statement from their 10K, we can see what this number represents. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is their net income, which of course is negative every year. This is the company's income statement from their 10K. Their revenue from product sales was only a few thousand in 2019 and 2020. It's over 400,000 in 2021. And their development revenue is up to 3.7 million, which is more than 3 times 2020. So that gives them total revenue of 4.1 million. Most of their revenue in 2021 was 3.4 million of contract revenue. Contract revenue represents deferred revenue, which is money they received in the past. So it's possible they received this revenue 1 or 2 years ago and they're booking it now in 2021. They were able to book the revenue by hitting certain performance milestones. Their cost of revenue is $676 million, so their gross profit is $3.4 million. They do have really good gross margins, 83%. Gross margin is gross profit over revenue. The average in their industry is only 30%. They spent $2.3 million in marketing, $30 million in general and administrative expenses. A lot of that is payroll or stock-based compensation. $9.5 million in R&D, so they have an operating loss. The reason their net income was so bad in 2021 was this $40 million loss. This $40 million is not a cash loss. These are revaluation losses on their convertible securities. If their stock price goes up a lot, then these securities convert to equity, and they don't have to worry about paying the interest or the principal on this debt. But since their stock price keeps coming down, they have to continue paying on this debt. But like I said, this is a non-cash item, so we add it back on the statement of cash flows. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. They lost $35 million in 2021. Then you have CapEx, investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. Since they have negative free cash flow each year, they need to add equity and debt. They added a lot of debt in 2021, $15 million. In 2020, they added $5.7 million, then $3.6 million. The bad thing about adding debt is you have to pay the interest on your debt. And when you have negative operating cash flow, that means you get deeper into the hole. It's better to add capital stock to fund your business. Maybe they didn't want to add common stock since the price has come down so much. This is their operating cash flow section from their 10K. Even though they reported an accounting loss of $91 million, they only lost $35 million of cash flow because that $40 million is added back here since it's a non-cash item, as we mentioned earlier. They pretty much had no revenue up until now. Their revenue is forecasted to grow a lot, up to $71 million by the end of 2024. And if that happens, it looks like they'll have positive operating cash flow. This is their investing and financing sections in their statement of cash flows. They acquired $1.1 million of intangibles, $11.7 million of property, plant, and equipment. They received $147 million from the SPAC acquisition. And also in 2021, they spent $66 million on a business acquisition. This is from the company's annual report. Torchlight reverse takeover of $147 million. They received that, and they paid $66.1 million for the acquisition of Nanotech. They spent $10.4 million in PP&E. That was for construction of their Highfield Park facility, and also equipment purchases for that facility, and also their facility in Pleasanton. The intangibles they purchased were intellectual property assets from Interglass Technology in Switzerland. So in their investing section, they had a cash inflow of $65 million. In their financing section, they raised $14 million from selling promissory notes, and they raised $1.3 million from stock options. So they had a cash inflow of $16 million. Last year was a cash inflow of $6.3 million. They issued $3.6 million of debentures last year. Debentures are unsecured debt that are issued by a company. Unsecured means there's nothing backing the debt. The mortgage on your house is secured debt because the house is collateral backing the debt. This is the equity section on their 12/31 balance sheet. They have $335 million of equity. They raised $460 million from selling their business, and they lost $128 million from running their business. Let's look at the capital structure. $335 million of equity, $8 million of debt. They're 98% equity, 2% debt. They could pay off all the debt with the cash on their balance sheet and still have $42 million of cash left over. I gave them the lowest whack on Finbox, 9.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 5 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 5, that's $488 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $308 million. We divide that by 285 million shares. And we get a calculated stock price of 108. They're trading at 158, so they're trading at a 46% premium. It's a sell according to the model. The forecast is for their revenue to hit $71 million in 2024. I grew their revenue each year at the same rate until it hit $71 million by 2024. And I continued that same growth the next 2 years. The average company in their industry converts 7% of their revenue into free cash flow. So I multiplied their future revenue estimates in 25 and 26 by 7%. That's how I got their future free cash flows. And I assumed they would have negative free cash flow before that. Simply Wall Street is a lot higher than me. They're at 15 a share. They're saying it's 90% undervalued. This is where the stock has been trading since it IPO'd. All SPACs start at $10, but they did a 1-for-2 reverse stock split at this point, so that brought the stock up to $20. And you can see it's gone down a ton since that point. The stock is down 56% in the past 52 weeks, while the S&P is up 11%. The 52-week low is $1.38, the high is $22. and the stock is trading below its 50-day and 200-day moving average. 5 million shares are traded each day on this stock. Of the 285 million shares outstanding, 245 million are on float. 21% are held by institutions. And I know lots of people are shorting this stock. I read a lot of reports out there. Over 19% of the shares are shorted. A good sign is they're adding employees. In 2019 and 2020, they didn't have many people working there. Now they have 130. In the past 12 months, there's been an insider buy for 18,000 shares, a sell for 300,000 shares. The general public owns 61% of the company, 25% by institutions, 8% by private companies, and 6% by insiders. The biggest shareholder is Lambda Guard, 8%, then State Street, BlackRock, InnovaCorp, and Vanguard. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They're not bringing in much revenue, so they have a bad price to sales ratio. They do have a good price to book of 1.3. It's mainly from the cash they raised from the IPO. And we can't look at the price to free cash flow since they have negative free cash flow. Let's look at their non-current assets. 29 million of intangibles. Of that 29 million, 7.8 million of patents, 132,000 of trademarks, 15 million of developed technologies, 10 million of customer contracts, and the gross amount is 33 million. And that gets amortized onto their income statement. 4.2 million amortized. So the net balance is 29 million, which is what shows up on their balance sheet. They have 27 million of PP&E. Here's a breakdown of that 27 million. 500,000 of land, 5.5 million of buildings. They have computer equipment, computer software. The bulk of it is manufacturing equipment, 18 million. Office furniture, leasehold improvements, ERP software, and assets under construction, 8.9 million. The gross amount is 34 million, and that gets depreciated onto their income statement. 7.1 million of depreciation, and the net amount is 27 million. They have a ton of goodwill, 240 million. Goodwill is the premium you pay when you acquire another company. And they have 6.3 million of operating leases. Right of use assets means they're leasing an asset that's owned by another company. We'll also see this on their liability section since they owe lease payments. Here are the lease payments they owe on that right of use asset, 3.7 million. Deferred revenue is when you receive payment for a product or service before it's completed. Once they complete the product and deliver it to the customer, then they remove this from their balance sheet and book it onto their income statement as revenue. We talked about this earlier when we looked at the company's income statement. A big chunk of their revenue was from deferred revenue. 320 million of deferred tax liability. This will result in a cash outflow in the future, and 2.7 million of long-term debt. Their current ratio is 1.4, that's current assets over current liabilities. Same thing with the quick ratio since they have no inventory. Let's look at their current assets. 46 million of cash, 2.9 million of short-term investments, 1.7 million of receivables. This is how much money is owed to them. 3.5 million of prepaid expenses. This is when a company makes an advance payment for a product or service they're going to receive in the future. And the assets held for sale are preferred stock. We'll see this on their liability section as well. Let's look at their current liabilities. 13 million of payables. This is how much money they owe others. 500,000 of long-term debt. Here's that preferred stock of 76 million. 663,000 of operating leases. And 22,000 of expenses to retire assets. In 2021, they had negative 48 million of free cash flow. And they currently have 40 million of working capital, so it looks like they're going to be short. It looks like they're going to need to add some debt or equity over the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 45 companies in the same industry as Meta, and if they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They're worse in most categories. They rank 23rd in market cap. The average is 4.1 billion. They have a good price to book ratio. Their revenue growth is really high, but when you start at 1 million and go up to 4 million, it's not that impressive. To summarize, I have them trading at a 46% premium, and it really looks like this company has some cool technology. It's definitely a risky stock at this point, but they are trading at a really low level, so if you have a lot of faith in the company, there could be some big upside potential. It's probably way too early for me to invest at this point, But the company seems really impressive. I rank their free cash flows 1 out of 10, their revenue 2 out of 10, and their ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.